Mark Matthews joins us now. Let's take a conversation forward. Mark, good morning. Thank you for joining us. Mark, new look for the new year?
Yes, I'm so happy you noticed. I just noticed everybody else had a beard now, so I wanted to try something different.
Markets are trying something different, aren't they? There is a problem in the bond market. Yields have inverted, but equity markets are saying time to move on.
Well, the yields were briefly inverted on Friday last week and Monday this week. Since then, they're no longer inverted. But I think you're right that the bond market is the most important thing to watch right now. And the Federal Reserve has been indicating, obviously, a quite aggressive and front-loaded hiking cycle, which they started last month. And the futures market tells us the terminal rate will be at about 3% next summer. But James Bullard, the St. Louis Fed, who's a well-known hawk, he said he'd like it to be maybe at 3.5 by the end of this year. And the reason I'm telling you that is that currently the 10-year Treasury is at 2.6%. But if we think back to 2018, 2019, the last rate hike cycle, the peak in the Fed funds was 2.5%, which is quite a bit lower than 3.5, which is where we are. It looks like we're going. And the 10-year was at a peak of 3.2% back then. So I'm just thinking if we're really on our way to 3.5 with the Fed funds rate, we should be thinking about a 10-year Treasury maybe around 4%, something like that, which I don't think the market would be very comfortable with.
Mark, so why are equity markets not nervous? Are equity markets saying time to look beyond this year, which is 2022, time to focus on 2023? I mean, is this the forward-looking nature of the equity market, which in a sense is not really adding to a lot of volatility or any kind of a free fall?
The reason I love markets so much is because precisely this. We will look back and we will understand why they're going up. But right now, I don't think anybody can tell you with a straight face that they know. I will say the technicals recently have been strongly indicative of resumed uptrend. For example, we've recouped 2/3 of the loss so far this year. And when we look back in history, we find that most of the time when markets go up 2/3, they go up the whole 100% and take out the old high. But I could cite numerous other technical indicators from the spike and then retracement in the volatility index, the advanced decliner oscillators, that all point to usually the market being up 12 months later after these kind of things happen. So I guess if I had to choose a fundamental reason for the strength in the market is that inflation will come down and the Fed won't have to raise rates as much as we think. But right now, I don't see why the inflation rate should come down. So it's a little bit weird.
It is. But as an equity investor, Mark, especially when it comes to markets like India, and within minutes from now, we'll have the central bank announce its next policy move. One is thinking that it's going to be a hawkish stance, perhaps taking note from what the Fed did last time around and what the dot plot is indicating, which is aggressive rate hikes in the balance of the year as well. One is wondering, as an equity investor, what is it that you do, given that at an index level and as at many stocks and sector levels, you're already sitting close to the all-time peak. And then, of course, you have these, worries about what the quarterly earnings are going to throw up in terms of, an inflation hit, and whether or not you're going to see earnings deratings in specific pockets as opposed to others.
I don't have a good answer because I'm a little flummoxed myself. What I would just say is that over time, it's obvious that being invested in the market is better than owning cash. So if I had to guess which sectors would do better than others, I would say that the so-called long duration stories, the technology stories, the companies that have lots of great stories but not many profits are not the place to be in a rising rate environment. And what should be the place to be is commodities. And I think also banks have become really beaten up. But if rates are going up, then banks benefit from that. So I would have thought commodities and banks are the better place to be right now.
What about your feedback? The thing with digital media is that while you're on air on TV, the world watches you on digital also. And the feedback is get the original Mark Matthew back. The one on your screen is not Mark Matthews. He used to wear glasses and he had a beard. Is that the original Mark Matthews?
Oh, there are many disguises.
Well, that was the stay-at-home look, right? I'm guessing you're back at office, aren't you?
Yeah, correct. That's a good way of putting it.
Mark, so let's understand where India stands. And if I look at the realistic positioning, Russia is an uninvestable market right now. China has got the unique set of challenges which are perhaps here to stay. You got a problem in other emerging markets like Turkey where inflation, God forbid, 60%. I looked at the number 3 times before I framed that question. So do you think Indian markets will be a disproportionate beneficiary of what is happening in the world?
No, I don't think so, because they are lumped into this emerging market asset class. And so when people read the news about Russia or Turkey or whatever, Sri Lanka, they'll just think, oh, emerging markets, I don't want to be there. So perhaps within the emerging market asset class, investors who specialize in that would favor India. But that kind of investor would be a small minority of the total pool of wealth that gets dedicated to equities globally.
Okay. So Mark, in a world where inflation is real and it is here to stay, now we can argue about 1 year, 2 years, 3 years, but inflation is here to stay. How can one make portfolios which are Teflon coated against inflation and they protect your purchasing power?
The answer is simple. You own commodities. And there are countries that are very obviously correlated to commodities, both in their currencies and their markets. So they are Australia, Canada, South Africa, Indonesia, and Malaysia. There's probably a couple of others that I forgot, but those are the main ones. I might throw in the UK just because the UK stock market, I mean, the UK economy is not commodity based, of course, but the stock market, funnily enough, has a lot of commodity exposure. We chose Canada. We just bought Canada a few days ago as our place to get that kind of protection. And the reason is that the companies are very well run. The currency correlates with commodities. It has a good banking sector too, by the way, a cozy sort of oligopoly with high dividend yields. And I guess the cherry on the top is I'm Canadian, so that we decided to put some money to work there.
Okay, and if you come to India from Canada ever, Mark Matthews, I'm seeing it on live television. Please bring us some of that delicious maple syrup. We just don't get that over here. But just tracking all of this, and you bought Canada. You have time and again said, you want to go where you're going to get at least 15% earnings growth. As we enter the new financial year in India and ahead of earnings season, how confident are you folks that yes, that is the place to be, India, because you will see more than 15% earnings growth?
We had started the year with 18%. Now we're at 15%, and I feel pretty confident that we can maintain a forecast of 15% for next fiscal year, because I think that the oil price is not going to go back up to 130 thereabouts, and so. When we look also at what's driving earnings growth in India this year, it is sectors like IT and banks and the commodity companies themselves, so anyway, I don't want to ramble. I think 15% is achievable, and it is also something that makes India a bit unique, because in America, for example, I think they'll be lucky if they get, I don't know, 6% maybe.
Okay. Yes, so India standing out. And I think you have said in the past as well, India would be your top bet and you would take it over China as well. Mark, I just want to go back to one answer of yours right now where you talked about banks, you talked about tech, and you talked about commodities. So your investment strategy, would commodities be only through the equity markets or also on holding commodities? Yesterday we had a guest who talked about copper, for example. There's a lot that's being said about silver last year.
The precious metals are easy to buy, through ETFs or funds. The other commodities are trickier to buy them. I certainly wouldn't want to dabble in the futures market. It's complex and the rolls make it quite expensive in things like oil. So I think that equities are a good way to play them in the sense of the producers of them. And then specific to the precious metals, we could also access the physical, bullion, for example, in ETF form, and very comfortable doing that.
Mark, so if I may just extend your point on commodities, interest rates will move higher. Interest rates may stay higher for a long period of time. What happens to the underlying demand for commodities? And if the underlying demand for the commodities remain low, don't you think underlying prices in commodity-denominated markets could suffer?
I do think so, but I don't think we are at a point in any of the commodities yet where we're witnessing demand destruction. 6 months from now, it might be different, but I've seen no commodity go down because of anecdotal evidence of decreased purchases of it. And some of these can be very elastic. I mean, oil is typically very elastic, food as well. And the main reason why they should remain strong is that we have a war which doesn't look like it's going to end anytime soon, that is exacerbating a lot of supply in energy, for example, as well as food. And those can trickle through the entire chain in really quite remarkable ways. And the other thing I might throw in on the durable goods side is that COVID is the worst ever in China, and don't think they can back away from the zero COVID policy. And so we could also get a return to the supply chain disruption in the durable goods, and that would also be inflationary.
And that'll impact durables, electronics, automobiles. We've seen even shower gel in the United States. Those are the kind of supply disruptions that we did see last time round. But Mark Matthews, you folks are overweight in India. And the sense one gets from the conversation we're having with you today is you will stay overweight?
Yes, we will. And if I could briefly tell you the three reasons we like it is, number one, Indian growth was subpar over the last decade for reasons that are no longer with us, the NPAs, the deep structural reforms. So point number one is there's a lot of catch up in the economy that is happening naturally now of growth that should have happened during the preceding decade, but for the reasons I just mentioned, didn't. The second thing is the digital side, and that has a very beneficial impact on improving efficiency in the economy. And then I did want to say a third one. Oh, yes, it's the demographic dividend. So the working age population is in excess of the dependent age population. That happened 4 years ago, and it will remain the case until roughly 2055. And when I look back at history and see other countries when they entered this so kind of golden period of demographic that I just mentioned, they were accompanied by strong stock market performance over the following 10 years.
Okay, so that's why you now know Mark Matthews is overweight in India. He's got three big reasons and he highlighted them for you. So, Mark Matthews, what would your assessment be? We're going to take out the new all-time high and go further, because what is your assessment as far as that goes?
Yeah, I think we will, because as much as everything we talk about is negative, somehow the market climbs a wall of worry. And as I said earlier, I think it's only in retrospect that we'll be able to understand why this is happening. But we believe that the US stock market, which, as I said, has regrouped 2/3 of its loss so far this year, will take out a new high. That is the benchmark for the world. I mean, it's a $50 trillion market. By comparison, I think you might know better than I think India's one, maybe 1.5. So it really dominates everything else. And so if the US market can take out a new high, I think that other markets that are open, and India is one of them, will follow it. By the way, I want to retract that 1.5. I think India's higher than that, but I don't precisely remember what the number is.
That's Mark Matthews of Julius Baer, overweight in India, long India bull, saying where else will you go for getting at least 15% earnings growth? Thank you so much for joining us live today on this edition of The Market.